This is my book review on The Dhandho Investor by Mohnish Pabrai. So it's really focused on this idea of risking very little money to have a high chance of getting high returns. Okay. So pretty much look for situations with very limited downside risk and very high upside risk. You can find opportunities in business like this, but you need to be patient and strategic. The book starts off with the fact that at this time, which I think was like 2008, 2007, maybe 2010, 20% of all motels in the US were owned by Indian owners, right? And they're Indian immigrants. So he was pointing out, why is this happening? And he says that the very idea of being an immigrant at the time from India and like having very low optionality, it's like either you work a low minimum wage job, right? Kind of encourages people to get into the motel business because the motel business was failing. There was really bad, I don't know why, like the price of motels went down a lot. And so because these people had nothing to lose, they had a lot to gain, even though technically they were taking a gamble, they were taking a risk, but this was a very well calculated risk. So that was an example that he uses for a business like approach of this, but you can actually approach it with stocks. And that's actually what he focuses on too. He provides some insights into some of his own trading, but the main idea is kind of like, hey, let's place, a few large and infrequent bets on certain stocks, and let's do it typically when news overreacts or when people are overlooking this stock. So for example, like, if something goes all the way down, right, to like a really, really low level, and then you have to like, look, okay, is it worth it? Like, is it actually going down that low because it's going to go bankrupt? Or is it because people are overreacting, they're scared? So you can capitalize on these moments when people just, act so emotionally and they lose all reason. And you can use that to your kind of advantage here. So I'm gonna kind of share with you the Dhandho framework. So again, this could apply to businesses, and it kind of does, but also can apply to the idea of stocks. So it's important to think about both of them, right? So these are kind of the business ones, right? So buy existing businesses, so you don't have to start your own. Buy simple businesses and industries that have a very slow rate of change. Buy distressed businesses and distressed industries, as long as the industry is not going to implode. Buy businesses with a durable competitive advantage. Bet heavily when the odds are overwhelmingly in your favor, right? So notice it says overwhelmingly in your favor. It doesn't say that there's no risk. It doesn't say that you can't lose your money. It just says when the odds are much, much better for you, when they're much like with you, Focus on arbitrage, which is buying something and then immediately selling it at a higher price. No risk, and has applications in business, not just trading. For example, he uses, if there's no like 7-Eleven convenience store for a stretch of 20 miles, if you set up one closer to a town, you can charge slightly more and capture the traffic that is used to traveling further to that other 7-Eleven convenience store. The next one is buy businesses at big discounts to their underlying intrinsic value. Intrinsic value can be measured also by like how many assets do they have. So if you think about worst case scenario, this company goes completely bankrupt. They have to sell everything. How much is that worth, And then you can use that to be like, wow, is the stock below that price or above that price? And that's kind of a better understanding to be like, okay, how much risk is there here? Look for low risk, high uncertainty businesses because usually the stock market does not like high uncertainty. Understand low risk is important, but high uncertainty means that you have a good chance of actually winning, right? And like low risk means you don't have a chance to lose a ton of money. It's better to be a copycat than an innovator. Okay, so big takeaways here. Your reason for investing in a stock or a company should be very simple and easy to understand. The more complicated it is, or the more unsure you are, the more likely you should pause and think about something else before you take action. Good idea. It's a good idea to do 10% of your capital for each bet because the bottom bets can easily outperform the top ones, and you want to reflect that and capture that gain. I think actually there's a lot that you can learn from how venture capital firms do investing. They typically take on a lot of low risk opportunities, but they put a good amount of capital there and they split it pretty evenly. And as a result, right, one company can go all the way up to become a unicorn, right, being a billion or even, $10 billion company, and they could have just put in $1 million and they would get a huge return on their investment, right? And then at the same time, they can only lose whatever they put in. So that's a very good asymmetric kind of bet. Okay. Look for moments when mispricing occurs. Be greedy when others are fearful, and be fearful when others are greedy. Whenever there's a large, huge swing in price, it typically is not reflective of reality, whether it be an overreacted sell-off or an overreacted bullish upward move. If you want the big returns, you got to be ready to buy and hold, because as long as your underlying investing thesis is sound, you need time, at least 1 year, maybe 2 years, maybe even 3 years, right, for your thesis to play out. If you're looking to get out in a shorter time frame, you're opening and exposing yourself to much more risk. I'm not saying it's not possible. I'm not saying you don't have to do it, but you are exposing yourself to a lot more risk with a shorter kind of time frame. And then if after 2 to 3 years your investing thesis doesn't play out, it's safe to sell and say you're wrong. So don't be afraid to kind of get out after, it's been proven that you didn't really do too well. So some examples are, this has also been followed a lot by Warren Buffett, right? He bought Geico, and he's bought like a lot of other industries where there are a kind of slight risk there, in the sense of like the market risk, right? The market's like, yo, this seems pretty uncertain. It seems like they're going to go out of business. They have that assumption, but a lot of people don't do their homework. So they don't see that, on the actual balance sheet, they have a lot more. So even if they're going to get sold and bought out, the stock is actually below what they would have been bought out at anyway. So, and that's just an example of how you can kind of just go through the weeds, go through the details, use common sense, and actually make quite a bit. But it's going to take a long time. And that's why a lot of people can't do this, because they don't have the patience. If you have any questions, put them below. Otherwise, I'll see you in the next video.